Good afternoon, everyone, and welcome to the Monday Open, hosted by the Vantage private client team. My name is Ollie, and joining me here today is Tony. How you doing, Tony?
I'm good, Ollie. How about you?
Doing very well, thank you, mate. So moving into the structure for today's video, we'll start off covering the events of last week, focusing on the major market-moving events and the announcements, and dissecting the price movements as a result. We'll then switch over into the week ahead, where we'll focus on the upcoming major events of the week and give our take on how we expect prices to react to said announcements. Following from there, we'll shift into the technical corner, where we'll put a spotlight on a couple markets and speculate on potential price movements using our technical indicators. And then lastly, we'll move into our Q&A section, where Tony and I will answer some of the most commonly asked questions that we get from our clients. So without further ado, Tony, would you like to take it away with last week?
Sure, not a problem. Let's start with Japan. So on Tuesday, Bank of Japan announced the core CPI year on year. The actual figure came out as a 2.4%, slightly higher than the forecast 2.3% and the previous 2.2%. Now, according to Financial Times, that the current CPI reading supports the view that the inflation is stabilizing around the BOJ's 2% target range, reducing the urgency for immediate further rate hikes. However, on the same day, we're also seeing the Japanese government bond auction falls flat. As a result, the yield on 40-year bond rose 5 points to 3.335%. Now, generally speaking, when we're looking at a higher yield, it simply means there's a higher demand on the local currencies, which then leads to the stronger currencies overall. That being said, the equity market reacts very differently. As a result, we're looking at the Nikkei 225 dropped 1.05% to 37,909 points. Now, this is due to the potential strengthening of JPY create the fear to hurt export companies in Japan's exporting economy. Now, moving to the New Zealand, on Wednesday, we've seen that New Zealand announced the rate decision to cut the rates by 25 points to 3.25%. Now, for the AUD New Zealand dollar traders, the rate cut is well within the market expectations, and as a result, we did not see any significant movement. AUD NZD closed at 1.07689 on the day, dropping 0.56%. Now, back to home. On Wednesday, Aussie CPI year on year was released. The actual number came out as 2.4%. Well, it's kind of in line with a previous figure, but just slightly higher than the market forecast of 2.3%. It looks like, however, the markets have readjusted their previous pricing and the certainty of the future RBA rate cut. As a result, we're seeing the ASIC 200 closing lower at 8,405 points, down 0.73%. Ollie, what's your thoughts about this?
Well, the Aussie CPI data came in higher than expected. So that was the 2.4% against the 2.3 expectation, which is indicating to us that the inflationary pressures are continuing to weigh on the Aussie economy. From what we've seen in terms of the market reaction, the Aussie mostly struggled against major currencies last week, falling short week on week against the dollar, the euro, the pound, and the loonie. So it is worth noting, however, that the Aussie has started the week up against all the above mentioned currencies. So I do think this is due to growing speculation that the RBA will be looking to hold rates at the next meeting. So I actually saw a quote from BetaShares chief economist David Basanis, who was also sharing the sentiment. So he's come out stating that the disappointing CPI data is not good enough to justify an RBA rate cut as early as July. Bloomberg is currently has the likelihood of a rate cut in July around 70%. So I'll be looking to keep a close eye on this one to see if there's any changes in the forecast as well, and that'll feed into Aussie strength going forward as a result.
Good take. And to be honest, I personally also agree with the sentiment. Just because of 0.1% higher than forecast, it's not going to be deal breaker. But we will see how does it end up with. Now, let's move on to United States. Now, US core PCE price index month on month got released. The actual number came in as 0.1%, pretty much on par with the previous number and the market forecast. Now, worth mentioning, PCE stands for Personal Consumption Expenditures. It is Fed's preferred inflation index rather than CPI. So the results released on Friday was in line with the market expectations. Market responded positively to the PCE report, viewing it as a confirmation that inflation is under control. While in the meantime, the inflation where everybody's worried about tied to Trump's tariff has yet to manifest. At least on paper, it's not yet. However, on the other hand, the market is also factoring that the Fed might simply maintain its current rate given the data released. As a result, we're seeing on Friday closing the US barely had any movement. We're looking at SP 500 closed just 0.01% lower, Nasdaq down 0.11%, and Dow Jones closed 0.13% higher. However, to properly evaluate Fed possible movement on rate decision, PCE alone isn't a full picture, and this is the reason why the traders will also need to pay attention to what is about to release this week. So let's have a look at this week. In saying that, let's stay with United States a little longer. On Friday, U.S. unemployment rate and non-farm employment change will be released. For the unemployment rate, we're looking at previously setting on 4.2%. The forecast will be pretty much remain the same, whereas the non-farm employment changes previously we've seen adding 177,000 jobs. We're forecasting this time will be 130K instead. Now, these are critical indicators that traders need to watch out because they together have impact on both Fed monetary policy and the financial markets. Now, let's be clear on Fed dual mandate. First, the Fed is here to maximize employment. And the second thing is the price stability, which maintains that 2% inflation target. So what we're essentially looking at here, if the results come out with a lower or negative non-farm payroll, would indicate the job market got weakness, and then the perception on that will be economy will be slowing down, leads to Fed decision on pausing or cutting rates to stimulate the growth. By the same token, if we're looking at a higher unemployment rate, we'll signal a similar movement that leads to Fed to ease policy to create jobs overall, vice versa. So what does that really mean for the market? For the rate cut, we usually expect bullish reaction from the equity market, such as SP 500, whereas US dollars will get stronger in such a case, then impact the forex markets, and the gold in the other side could likely to be seen falls. Now, Ollie, what is your take on the predictions of this?
Well, mate, tying in from the data last week, you mentioned that the US index markets didn't really see too much reaction to the data release, but we did actually see the dollar strengthen against many of the major currencies on Friday following the PCE data coming out. In the wider context of the PCE release, the headline PCE rose to 2.1% year on year compared to the 2.2% forecast at the start of the year. So what this is suggesting to us is that inflationary pressures in the US are easing, or at least not really showing in the data right now, which in turn has increased the likelihood of a rate cut at the next Fed meeting. So tying it back into this week, I'm going to be keeping a close eye on the non-farm and the headline unemployment data to either reaffirm or basically send back the sentiment of a Fed rate cut at the next meeting. Typically, the central banks...
Take on.
Oh, sorry, mate. Typically, the central banks will respond to the high unemployment with rate cuts in order to stimulate the spending, as you just mentioned before. So I'm expecting a weaker dollar if the unemployment data does rise, as the markets start to price in a rate cut at the next meeting. Also, just want to mention as well to everyone watching, please do remember that if we are looking at dollar weakness in the lead up to the decision over the week, we should focus on the key price points from the previous swing highs and the lows, which should, in theory, help to give us an indication of the momentum strength as traders speculate and price in potential USD movements.
All right, thank you very much for the take on in that. So let's move on to the other parts of the world, actually, United States neighborhood here. On Wednesday, we'll be looking at Bank of Canada will announce the overnight rate. Now, previously, this number sets at 2.75%. Now, first of all, let's have a better understanding of what overnight rate is and how it's related to the investment market. So, first of all, overnight rate is an interest rate where major financial institutions borrow and lend funds amongst themselves. Usually, this is a very short term, like one day, hence we call it overnight. It influences the inflation rate as a part of the central bank's monetary policies, and the monetary policy from central bank will then impact on the strength of local currency as well as the equity market. Now, Ollie, what can you tell us about this BOC overnight rate announcement?
Well, so I've been following the loonie a little bit to see what's going on with the prices. So the forecast for the Bank of Canada decision is expecting a 25 basis point rate cut, bringing the overnight rate to 2.5%. As for the impact this will have on the Canadian dollar, in theory, we should expect a weaker Canadian dollar once the rates have dropped. We've already started seeing this with with Canadian weakness being priced in to start the week. Currently, the loonie is down against the pound, euro, the yen, and the Aussie, and I'm expecting this to carry into the week ahead. I guess this ties nicely into the next point as well, Tony, if you wanted to take it on.
Yeah, sure, no problem at all. Actually, one more thing before we move on to the next point. This Friday, there's a Canada unemployment rate to be announced. And as a result, I think traders also wanted to watch that as a part of the pictures that might be impacting the overall monetary policies. All right, so let's move to Europe. On Thursday, ECB, European Central Bank, will announce the main refinancing rate as well as their monetary policy statement. Now, unlike the overnight rate we just actually talked about, the main financing rate is one of the key interest rates that the European Central Bank used that plays a crucial role in monetary policy. In simple terms, it is the interest rate where commercial banks can borrow money from the central bank. Now, the impact to the actual market, first of all, would be the loan and mortgage rates. Simply put, if it costs me, the bank, to lend the money to you, then surely it will cost you to repay them back to me. That's the idea. Now, generally speaking, higher rates usually cools the demand due to higher borrowing cost, hence reducing the inflation rate. While in the meantime, there will be a negative impact on the stock market, we believe. So what we're looking at here, higher rates usually means bearish stock market in EU, while euro currency will be strengthened and vice versa. Now that concludes the news section from me. Ollie, why don't you give us a technical spin on the markets?
Unreal. Thank you, Tony. I'm just going to share my screen with everyone. All right. Too easy. Okay, so to start off, we're going to be looking at the pound against the Canadian. Right now, we're on the 1 week chart. So what I'm seeing here is an upward trending market dating back to November 22. So we can see most recently it hit the upper Bollinger Band before consolidating back towards its moving average. However, it did fail to reach its previous highs, which is suggesting to me a slowdown of the market trend and a potential period of price consolidation. So if we move the weekly into the daily chart, we can see the prices are still currently sitting above its 50-hour, 100-hour, 200-hour moving averages. All of them are evenly spaced and trending upward in the same direction, which is suggesting upward momentum is still largely carrying the price. Now I'll consolidate this one down to the 4-hour chart as well. So in terms of the current market opportunities, we can see the prices on Friday dip significantly following the positive data release, as we just touched on, which was testing the lower Bollinger Band here. However, seeing the upper and the lower Bollinger Band just here, they've been blown out a little bit. So I'm expecting a consolidation of the price back towards its moving averages. So for this week, I'll be looking to get into a short-term buy on the pound Canadian at the market price with its target around the 100-hour moving average, just around here, with a stop around last week's low just down here. So the next market I wanted to move into is the euro against the Aussie. Again, we're starting off on the weekly just here. So if we're dating it back to March 2023, I'm seeing a range-bound market. However, we did see it at March this year, just around here, that the prices did jump up around here and then consolidated back to the upper band around the 1.72 mark. Although it did since bounce back on that one, and it has failed to reach the previous highs. You can see that again as well. If we shift onto the daily here, we can see it drop back down, tested around here just above the 1.72 mark, raised up, failed to reach previous highs, and is currently on a bit of a downtrend for the day to start the week. So shift this into the 4-hour chart just here. So we can see that the prices are steadily increasing over the previous month. However, there was some selling to finish off the session last Friday, which is telling me, which sent the sell sentiment carrying into the weekend and is seeing right here to start the week. If we can see down here on our MACD indicator that the MACD line has just shifted below the signal line, which is highlighting to me there is sell momentum taking over this market going into the week ahead. So for a trade on this one, I'm going to be looking for it to retest the previous swing low, about the 1.747-ish mark. And I'll be putting a stop towards previous week's high just up around here. So that is all from me in terms of the technicals for this week. So Tony, would you like to take it away with question 1 on the Q&A section?
Yeah, sure, not a problem. Let's start with the first one. This is a question I've been asked a lot by my client: how to determine stop loss and take profit. Now, stop loss and a take profit are essential part of a risk management when trading CFDs. So generally speaking, there are a few ways to determine how to set up your exit strategy. Now, first part is you could actually consider, based on your expected risk to reward ratio, that standard the ratio might be, say, 1 to 3, meaning that if I risk $100 where my stop loss is, I shall aim to make $300 as a reward of taking this risk, where would be my take profit line. Alternatively, traders can actually set them up based on your risk appetite. Now, what does that mean is to decide on a fixed percentage of a capital you're willing to lose per trade. For example, 1 to 2%. Or by the same token, how much I am satisfied to take a profit out of this trade, that will be where your take profit is. Last but not least, you could also actually judge or decide that based on the technical side of the story there. Usually, stop loss will be below the supporting level for longs and just above the resistance level for shorts, where the take profit will be the opposite, how you would set up a stop loss. Now, for risk management point of view, always set up your stop loss and take profit before you enter the trade. Avoiding to setting them too tight, because it allows you to actually give some rooms for the market volatility. And do not, and I repeat, do not move your stops without a valid reason. Discipline is a key. That's from me. Ollie, how about you take on the next one?
All right, well, thank you for that one, Tony. So question 2 again is, how do you speculate on gold pricing? Personally, when I'm looking to trade gold, I'm following much more of a fundamental heavy analysis. Reason for this is, from what I've seen, particularly over the last year, that gold trends and market sentiment surrounding the safe haven asset is largely being determined by global headlines and data releases impacting on the US dollar in particular. I'll bring in the technical analysis mostly when it comes into identifying my entry levels, price targets, and stops, as you just mentioned on there, Tony. But I do find that the fundamental analysis largely does determine my trade direction. Okay, so this brings us to the end of the video for today. The recording of this live stream will be up on our YouTube channel, as well as in the VIP trading room later today. If you haven't visited our VIP chat room yet, please do. We post a lot of market content along with an overnight market summary in there each day. For anyone who'd like to sign up for our newsletter, please feel free to reach out in the VIP chat room or reach out to one of the relationship managers directly. Well, that's all from me. I'll catch you later, Tony.
Thank you for having me. See you next week.
All right, cheers.
Bye-bye.